This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Serezna.
Let's get to that chart deck. Listeners, you'll find that download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Luke's picture that says, looking for the downloads. So Nick, let's talk some charts. On page 2, I have that S&P 500. I want to talk about the levels that you're watching because we got a lot of news coming out. Not only do we have the initial inflation kind of number with the PPI coming out tomorrow, but next week we're going to have CPI on Tuesday, followed by the FOMC statement and press conference coming out on Wednesday. And so I'm really curious as to how the options market is pricing volatility in going into next week's headlines.
Yeah, well, looking at next Friday's expiration, which again, as you said, factors in FOMC, CPI, and this Friday's PPI data, we have an expected move on SPX of about 130 points in either direction. So from the current price, upside's around like 40.50 roughly. Downside would be around 3,800. Support right now is, again, pretty heavy at 3,700. 3,900 has been acting as support recently as well. On the upside, resistance would be 41.20 approximately. So I do think we're going to see a lot of volatility, possibly the most volatile week we've seen in many months next week, given the CPI and FOMC data. Eric, what are your thoughts on the S&P right here?
Well, as David Rosenberg said in last week's feature interview, most bear market rallies have failed at or near the 200-day moving average. Now, we did move above the 200 last week, but only for 2 daily closes. Last week, I said if this market was going to roll over and reverse to the downside, it needed to do so pretty darn soon. Well, I guess the market got the message because it sure looks to me like what we have here is a fake break above the 200-day moving average, and the bear market rally has probably topped out. But I also note that despite trading well below the 100-day moving average on Wednesday, a late-day rally brought us back up to close right on the 100-day at around 39.37 on Wednesday. So we haven't seen a decisive close below the 100-day moving average quite yet. So I suppose there's maybe still some room for this to be a bear trap in bull trap's clothing, but I'm still leaning toward the view that the top is probably in, the bear market is probably over, and we're likely to see more downside. My conviction on that bearish view will increase considerably if we see another red daily candle on Thursday and a close well below the 100-day moving average, which right now is right around 39.37 on the S&P.
Yeah, Eric, when you're talking about that 200-day moving average, I put it up on that chart. And, I get that David Rosenberg and your views about the rejection there in his bear market rally. But I think that from a market timing perspective, it's one extra layer for me. I want to start seeing when the price action has definitively started to show distribution. And up until this week, the market has been very systematically doing a relatively bullishly tilted price action, which is all dips getting bought. It continued to make progress. And I think that the real tell for me is going to actually be on how the price action behaves once we get all of these headlines. I actually suspect that, and I wouldn't rule out anyway, the idea that the market can even break to a higher high above 4,100 temporarily just to kind of wash out eager shorts that may have stops a little too tight. But overall, I feel that this 2-month bear market rally is getting a little bit longer in the tooth. And now that we're going right into the middle of December with all these big headlines, I'm curious whether or not we see this kind of mid-December turn point in the market and certainly something that I'm watching. Anyway, moving on, Nick, I wanted to, on page 3, we have the NASDAQ. And, my first observation, I want to know the levels, obviously, what the market's anticipating. But when we're looking at these Qs, the price action on those FANG stocks continues to just be brutal. I mean, I know Microsoft has bounced a little bit, but Apple and Amazon and so many of these other names just continue to just have a really rough-looking charts. But what are you seeing here in the options market in terms of the levels?
Yeah, so looking at next week's expiration again for December 16th, which again factors in FOMC and CPI, we're going to see approximately a 12-point move on the Qs. So from the current price, it's around 282 as we speak. We have upside of around 294, 295-ish. And right now, resistance is around 300 on Qs. We have a gap fill again at 310-ish. We also have a gap fill to the downside at 368 approximately. Support area would be around 260 right here. 280 is also heavy support as well. But again, I do think we're going to see a significant move by next Friday, given the data we're going to get in the next week or so. And as you said, the FANGman names, especially Meta, Amazon, Netflix, Google, Apple, they're not looking too hot right now. Meta was pushing toward that gap fill at 130, and then it broke back down again with the negative EU news. So it's possible we see another downside move to that gap fill at 268 area. But again, it's all contingent on the PPI, CPI, and FOMC data that we get in the next week or so.
Yeah, ultimately, it's going to stay correlated to that S&P 500. So it's going to be what direction the whole market takes in the next move. One of the things that I'm curious about is whether the NASDAQ continues to demonstrate a relative underperformance and if the S&P does take a turn down, will the Qs once again be the ones getting hammered the most? I don't know if I would say that there's a very reasonable chance that's the case. I generally want to be underweight the Qs on a relative basis. But what was interesting, though, for me, Nick, was looking at volatility. Like even last week, the VIX, which we have on page 4, temporarily even traded below 20. And it's amazing, we have this bear market rally, so many people skeptical about its sustainability, yet the cost of volatility to hedge up your portfolio is still relatively affordable compared to where volatility's been trading over the course of the year. What's your thinking? Did we put in a short-term bottom in the VIX, and what's your thoughts here?
I do think we did put a short-term bottom in the VIX for sure, because looking at the chart over the last year, we can see heavy support at 20 or so. And each time we've bottomed out, we've risen very rapidly off the bottom and pushed above 30, about 5 times so far in this past year. I don't expect anything different going forward, especially with the data we have coming out in the next week or so. So I do expect to push above 25 perhaps, where we're going to see those 2% daily moves each day in the broad markets. And also looking at the put to call interest right now on the VIX, it's 0.2 right now, meaning that there are 5 calls being opened per put being opened right now, which is pretty bearish overall. But again, you mentioned that the hedging costs aren't that expensive in the short term, and I do agree with that. We'll discuss that in a little bit, I guess. Now, moving on to the U.S. dollar on page 5, Eric, has anything changed in your thinking?
Another week, another confirmation of the ongoing downtrend in the Dixie. Last week, I observed that 105.5 was the level to watch, and it clearly broke lower. We tested 104, which was the bottom back in August, just before the big parabolic move up to the top at 115. What we're seeing now is a nice bounce here off of that 104 support level, but how long will it last? It already seems clear that the trend has reversed to the downside, at least in the short to intermediate term. A daily close below 104 will provide further confirmation of that.
Well, Eric, I do get the point. It is still in a distribution cycle, but increasingly, my view here is that even if the Dixie does have a dip down to 103, and on the short term we have some volatility on all these headlines, I think the next 5 to 10 point move on the Dixie is actually to the upside, not to the downside. And so one of the things that, while I agree that the prevailing downtrend is dominant, lower highs, lower lows, it is being sold. One of the things that I'm spending a lot of time with my members trying to discover where the short-term lows of the dollar really start to form, and where will we have some asymmetric moment to put on a long trade there. So while the trend is still very dominant on the downside, I think that it's inevitable here that we're going to get some sort of counter trend move, or at least the US dollar resuming its 2022 bull trend.
Let's move on to gold here. Eric, what are you thinking of this breakout?
Well, needless to say, the brisk rally of almost $200 an ounce off the early November lows is exciting news for the gold bulls. And as I mentioned last week, I added to my long positions on the brief dip down to $17.20. We briefly tested $18.20 this week, fully $100 over where I added just over a week earlier. So to be sure, this rally feels good so far. But it behooves traders to always do their best to understand why the market is running in their favor, because otherwise we wouldn't know when to take profits. When this rally began, I assumed that the primary proximal catalyst and driving force was the perception that inflation had peaked and that both nominal and real rates would soon move lower. Now, that explanation makes logical sense, but frankly, it's hard to explain a move of this magnitude with that explanation alone. So I've been pondering, what else could be the driver? The next most obvious answer is central bank gold buying. That makes perfect sense, but the catalyst for that was the U.S. seizing Russian FX reserves more than 6 months ago, causing other central banks to begin questioning the security of their own dollar-denominated reserves. But it doesn't explain why the gold market would continue selling off for fully 6 months after the writing on the wall clearly showed reason for central banks to reconsider the U.S. holdings. And then for the gold market to suddenly rocket higher on November 4th, well before the November CPI data was released. Credit Suisse analyst and former Federal Reserve staffer Zoltan Pozsar penned a piece this week positing that Russia might soon begin demanding payment for its oil exports in gold rather than U.S. dollars as a sort of countersanction. Someone having inside information that was coming back on November 4th seems a better explanation for the sudden runaway gold price rally than the CPI print alone, which wasn't even out on November 4th. Meanwhile, our good friends at Saxo Bank published their 2023 outrageous predictions, and among them was the scenario of gold moving over $3,000 an ounce next year. So I'll be watching the market closely when we get this month's CPI print next Tuesday, December 13th, and try to gauge the extent to which inflation and policy rate expectations are driving this market, or if something else is in play. I'm generally of the strong opinion that it's probably something else in play, but I'm undecided on exactly what that something is. One way or another, I love the price action so far.
Yeah, Eric, I mean, what's interesting about, is that overall, I get the idea of gold making its big move. In fact, I've always been pretty consistently on my stance that I'm bullish gold over the longer term. The big question for me remains as to, after gold finishes this little spurt higher, which I think could easily still see advances towards even 1900. But if the whole stock market was to have a challenging period, and let's just say some sort of tight liquidity conditions, cause the stock markets to wobble and go through another bear decline. The question is that in those kind of liquidity conditions, will gold be able to buck the trend and maintain this upper end, or will we see a lot of deja vu where we've seen, like even let's say 2020 or any of those other places where you basically had gold just succumb to the selling and go through a sell cycle. And so I have a longer-term bull view on gold, but simply asking the question as to whether it could weather those liquidity conditions and hold up. And this is where hedging gold is something that's high up on my priority list as it continues to rally. Moving on, though, to page 7, I had that chart on crude oil. And what we clearly have is crude oil having broken those lows from September and November on the downside. And the big question is, are we going to see a sell cycle that weakens all the way down to the December 2021 levels, where we can, let's say, dip down to $65? Or will this kind of $70 range be able to defend and hold crude oil prices in here? Whether or not there's one quick little dip towards 65, or whether 70 plus holds the lows, I, for the first time, think that there's legit asymmetry in dabbling long crude oil, because to me, I don't see the downside risk of crude to being down to like 50 or 60 or something like that on the downside. And even just a return of crude oil back to where it was trading in November near 90 is almost a $20 upside. And so to me, starting to put on some oil trades here, dabbling with where a short-term low may form, is certainly something that I'm entertaining here, and something I'm spending some time with the members trying to figure out where the timing on that trade is. Now, with that, on page 8, Nick, we have an option strategy we wanted to share. Like last week, we started talking about different ways to hedge out the downside risk if there was to be another downturn in the market. And we talked a lot about spread trades, but we said that it's a good conversation that we should keep elaborating on. And one of the strategies that we loosely talked about is what's the idea, or what about the idea of using like a butterfly spread as a way to hedge? So I'm going to let you kind of dive into it on page 8 here and explain, how you constructed this butterfly, and then maybe how the payoff profile works, and then we can chat about it.
Sure, sounds good. So looking at this butterfly put spread, the way this works is essentially constructed by buying one 3,700 strike put option for the January next year OPEX, selling 2 of the 3,500 strike puts in the middle, and then buying one 3,300 strike put on the downside right there. So essentially what happens here is you have a debit of approximately $17 right now, which is times 100 shares per contract, obviously. So it's $1,700. And the upside here is up to $20,000 overall. So $20,000 minus $1,700 would be $18,300 upside. Now, again, this would act as a hedge down toward that middle strike of 3,500, which was the October low from last year. So we're looking at those lows as the middle point for the January OPEX. And this is a good hedge because, again, buying the puts on their own is very expensive. So buying those puts will be very, very costly to the average person that wants to hedge their portfolio. This is a more risk-managed approach to hedging your portfolio with less capital. So again, the risk here would be about $1,700 per contract. And the upside here would be maximum 18,311 or so, as it shows right there in the max return box to the left of the screen.
So Nick, so I've put on butterflies before, and the interesting thing, and it's important to note that while it looks like a very sexy payoff profile, it is actually in order to hit that max profit point, you have to be in the sweet spot of being right about the timing and as well the level for this in order to get that max payoff. And often what ends up happening is you're right about the price, but it got to, let's say, the level way before the butterfly is about to expire or something like this. And often what you'll see is that if you're using this as a hedge in the market, let's say, so here we have a hedge that's like 45 days out. So we're a month and a half. You're betting that just in case something starts to downturn here in the post FOMC, and you have out till January for a hedge that has the S&P retesting its year low, down obviously towards 3,500. Now, if we got there, for instance, in just a month, and there's still 2-3 weeks, you're not going to have the exact same, you're not going to be anywhere near anyway the max profitability. But I don't consider that a negative, but it's also just simply about managing expectations and sizing the trade correctly. But what makes a hedge like this even more interesting is if you can find, because it's so cheap to put it on, and it has such a nice payoff profile, if you can find a way to pay for the hedge through creating credit off of your other investments, it allows the hedge to have that kind of almost a lottery ticket effect of helping you when you need it, when the whole market downturns. Like what would you do to approach bringing the cost of this down a little bit further?
So there are many ways you could do that, obviously. One way could be to sell credit call spreads on the SPX directly. If you have a portfolio of long positions already, you could also sell out of the money call options or covered calls against your positions to make up the difference here in the debit amount on the butterfly put spread. That would essentially pay for your insurance using covered call premium on your assets you have in your portfolio. Obviously, that would limit your upside in the short term on those assets. So remember that too. But yeah, Patrick is absolutely correct in terms of understanding that the middle strike 3,500 is the main area where you're going to see the maximum profit. But that being said, if we get there too soon, for example, the payoff won't be maximum profit. You might be there at 3 to 5x return on your initial investment. And my strategy, the way I usually play these positions is if I have more than one contract, which is usually the case, I tend to sell one contract or half the position when it doubles in value, which then allows me to ride the position for free without any actual risk anymore. So for example, let's say you bought 2 contracts at a debit cost of 3,400 approximately, and then the position doubles in value to 3,400, you sell one contract. That then removes your initial debit cost to 0, and you have upside of 20K. Again, remembering that in order to achieve that, you have to be at 3,500 near the expiration date of the January OPEX for next year. So it's very important to also mention as well. Also important to note too that there are 2 different break-evens on butterflies, as noted in the chart over here. 36.83 is the first break-even, which is the highest strike less the debit cost. And then the second break-even is 33.16 approximately, because obviously if we overshoot the middle strike and go toward the downside, you can also lose if we go below 3,300. So important to note there as well. Butterflies are not typically used by novice investors. They're more nuanced, so it's important to note that as well. But again, just an idea to share to kind of get your creative juices flowing on how to hedge your portfolios with limited premium being spent.
Absolutely, and that's the key is that just buying gamma outright to buy an absolute downside risk tends to be very expensive, and unless you get a really big move in the markets and you're somewhat right about the timing of it, which is what is only the best case scenario for buying just, let's say, an outright put hedge. These are easier ways to carry protection at a much lower cost, and I think that's a very important way of approaching it, is always having some sort of insurance, but not having it eat away at your returns by overpaying. And so that's why I thought it was a really interesting way that you approach it. Thanks for sharing that, Nick.
My pleasure.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.